what taxes do landlords pay on rental profits? When you're letting out a property, you will need to pay tax on the profits you make, and different taxes are due depending on whether the property is owned personally or via a limited company. Landlords who personally own their buy-to-let property pay income tax, whereas those who own property through a limited company pay corporation tax on profits. Let's take a look at the specifics of these two taxes, including how they're calculated and what sort of impact they could have. I'm James Poyser. I'm the CEO here at Provestor, the property accountants, and we're here to help you with all things property tax. First of all, let's look at income tax. When you own a property in your own name, rental profit is added to your other earnings, such as from your job, and taxed as income. For example, if you're a higher rate taxpayer and your property generates £6,000 of profit per year, you'll need to pay tax of 40% on these profits. Each year, you'll tell HMRC how much profit you've made from your properties and calculate the tax due. You can do this via a self-assessment tax return, and of course, if you're a Provestor client, we can take care of this for you. There is a small allowance available. The first £1,000 of income from your property is tax-free, and this is known as your property allowance. The remaining profits will then be taxed at your personal tax rate. Keep in mind that your rental profits can push you up into a higher tax band. For example, if you have two buy-to-let properties that you own personally and make £12,000 per year of profit from these properties, in addition to a £40,000 per year salary, this would tip you over the threshold into the higher rate tax band. This can start to impact the profitability of your properties. As you'd expect, there are allowable expenses that you can deduct from your profit to reduce your tax. This is why it's so important to track and claim your expenses properly, as doing so can reduce your taxable profit and therefore the amount of tax you need to pay. One of the benefits of appointing Provestor is that we provide you with an app that makes this simple. Now, let's look at company-owned properties. Holding property in a limited company can offer tax benefits. If you're a high-rate taxpayer or plan on owning multiple properties, you'll especially find there's a tax saving. Rental profits on properties held in a limited company are not taxed at your personal rate, but at the current rate of corporation tax, which today is 19%. What's more, the allowances for mortgage interest are more generous, reducing your tax bill further. Now, what about taking profits out of your limited company? Is the tax to pay on that? Well, if you keep profits in your company after corporation tax, there is no more tax to pay. But what if you do want to take your profits out? Before we continue, I just want to call out some free resources that you might find useful. Head to the description below and you'll find links to our expert guides, calculators and fact sheets, all of which are freely available on the Provestor website. Check them out and let us know in the comments if you found them useful. One option is to pay yourself a dividend. The first £2,000 per year of dividends are tax-free, and above this you'll pay tax at a rate that's linked to your personal tax band. The rates are here in this table. It's 7.5% for a basic rate taxpayer, 32.5% for a higher rate taxpayer, and 38.1% for an additional rate taxpayer. Also, keep in mind that from April 2022, tax will increase by 1.25% to support the NHS and social care. As an alternative to dividends, you could pay a salary to yourself and other family members. For example, you may wish to pay your children for supporting you with the administration or upkeep of your portfolio. If you're saving for retirement, you can invest in a company pension, which is a tax-efficient way of building a savings pot. Pension contributions are classed as an allowable business expense, so this can be offset against corporation tax. And of course, you can build profits within your business to spend on your next investment property. As a director, you have the flexibility to choose what to do with the profits, and this flexibility can help you with your personal tax planning. In summary, there are multiple options for tax efficiency and taking profits out of your business. It all depends on what your goals are. If you'd like help with your tax planning, why not book a 45-minute tax consultation with one of our accountants? Click on the link above to find out more. Thank you for watching this video. I hope it has been a useful overview of taxes on rental income. If you found this useful, please like this video, subscribe to our channel, and if you have any questions, drop a comment below. I hope you've enjoyed this video, and I'll see you in the next one.